Hello, and welcome to my channel. Today, we're dealing with a topic that can trigger both fear and hope in equal measure: recessions. When we think of a recession, images of economic downturns, rising unemployment, and falling stock markets come to mind. But what if I told you that recessions can also be golden opportunities to achieve financial freedom? In this video, you'll learn how some of the world's most successful investors, like Benjamin Graham and Warren Buffett, have used recessions as opportunities to make great investments. We'll dive deep into what a recession really is, its stages, its impacts on businesses and the wider economy, and how you can overcome the fear of recessions. Finally, we'll look into the strategies Graham and Buffett used during these periods and how you can apply this wisdom to your own investments. Let's dive right in. Chapter 1. What is a recession? Definition and general characteristics of a recession. A recession is a phase in the economic cycle characterized by a significant decline in economic activity. This decline is usually reflected by a fall in gross domestic product, GDP, over 2 consecutive quarters. However, the definition goes beyond this technical marker. Recessions affect society as a whole, from rising unemployment and falling wages to deteriorating corporate profits and shrinking business prospects. The 4 phases of the economic cycle. To better understand recessions, it's essential to know the 4 key phases of the economic cycle. 1. Expansion. In this phase, the economy is growing, markets are flourishing, and companies are expanding. Hiring rates rise, production increases, and consumer confidence is strong. However, excessive demand can lead to inflation. 2. Boom. When the economy hits maximum capacity, a boom occurs. Prices rise sharply, and speculative bubbles often form. Central banks may raise interest rates to cool the overheated economy. 3rd recession. After the boom, the economy slows down. Companies cut investments, reduce production, and lay off workers. Unemployment rises, further weakening consumption, leading to falling stock markets. 4. Recovery. Following a recession, the economy starts to recover. Businesses begin to hire again, consumer spending increases, and the stock market rallies. Gradual confidence builds into strong growth. Chapter 2. The impact of a recession on companies and the economy. Negative impact on companies' recessions pose significant challenges for businesses, particularly those in highly cyclical industries or with weak balance sheets. A decline in demand for goods and services results in lower sales and profits. Many companies are forced to cut costs by laying off employees, closing sites, or reducing investments. This can harm their long-term growth prospects. Special challenges for small and medium-sized enterprises, SMEs. Small and medium-sized enterprises, SMEs, are especially vulnerable during recessions. Compared to larger corporations, SMEs often have fewer financial reserves and less access to credit. They rely more on local markets, which may suffer heavily during a downturn. As a result, SMEs often experience higher insolvency rates. Financial stress and credit markets. During a recession, access to capital becomes increasingly difficult. Banks and lenders tighten lending terms, restricting companies' ability to secure the credit needed to maintain liquidity or invest in growth. Even businesses with solid models can face insolvency if they lack sufficient liquidity. Positive effects: market shakeout and increased efficiency. Though painful, recessions can have positive long-term effects. They force companies to rethink their business models, eliminate inefficiencies, and focus on their core strengths. Inefficient companies are pushed out of the market, allowing stronger and more innovative players to emerge. Recessions as catalysts for innovation history shows that recessions often drive innovation. Companies forced to rethink their strategies may develop new ways to improve their products, optimize their cost structure, and open new markets. Technological innovations that revolutionize industries often emerge during economic downturns. Chapter 3. Why are people afraid of recessions? Psychological factors. Fear of recession is deeply rooted in human psychology. Uncertainty plays a significant role. People feel they are losing control over their financial future, causing severe stress. This fear is compounded by the phenomenon of loss aversion. People feel the pain of loss more strongly than the joy of an equivalent gain. The influence of social dynamics and groupthink. Groupthink also plays a major role. During recessions, people tend to mimic the actions and opinions of others. If the majority are pessimistic, spending less, or selling assets, others feel pressured to do the same. This collective panic can intensify negative economic trends. Media coverage and its impact. The media often exacerbates recession fears. By focusing on negative forecasts and dramatic headlines, the media amplifies public anxiety. Negative coverage tends to sell better, creating a vicious cycle where panic drives the news, and the news fuels more panic. Economic uncertainty and job losses. One of the major reasons people fear recessions is the risk of job loss. Unemployment tends to rise, leading to financial difficulties. The prospect of losing income or seeing one's purchasing power reduced creates stress, causing people to cut back on spending, which worsens the economic situation. Lack of financial education. A lack of financial education is another factor contributing to recession fear. Many people do not understand how financial markets work, which leads to irrational behavior, like panic selling or avoiding investments altogether. Financial fragility. Lastly, many households lack sufficient reserves to weather a sudden loss of income. Without a financial safety net, even small economic losses can create big problems, further increasing fear during recessions. Chapter 4. Investment Strategies in Recessions. Benjamin Graham's Principles of Value Investing. Benjamin Graham, known as the father of value investing, developed a strategy that involves buying undervalued stocks, those whose market prices are significantly below their intrinsic value. This provides a margin of safety, protecting investors from losses if market conditions worsen. Graham's philosophy is especially useful during recessions when markets overreact and prices fall dramatically. The margin of safety. The margin of safety is the gap between the intrinsic value of a stock and its market price. During a recession, when markets are overly pessimistic, this margin grows wider, giving informed investors the chance to buy high-quality companies at discounted prices. Warren Buffett's approach. Adapting Graham's teachings. Warren Buffett, a student of Benjamin Graham, adapted his mentor's teachings. While Graham focused primarily on numbers, Buffett emphasizes the quality of the company and its management. Buffett seeks out companies with strong competitive advantages that can generate high returns over long periods. Buffett's long-term strategy. Buffett's famous quote, "Be fearful when others are greedy, and be greedy when others are fearful," encapsulates his approach to recessions. While others panic and sell, Buffett buys. He believes in purchasing stocks during recessions when they are undervalued and holding them until the market recovers. Practical examples of Buffett's strategy. A notable example of Buffett's recession strategy is his investment in American Express in the 1960s. Despite a financial scandal that caused its shares to plummet, Buffett saw long-term value in the company. His investment paid off when American Express recovered and its stock price soared. Thanks for sticking with us till the end. If you found value in today's video, be sure to hit that like button and subscribe for more insightful content on investing, finance, and strategies to help you thrive in any economic situation. Don't forget to turn on notifications so you never miss out on our future videos. Let us know in the comments what topic you'd like us to cover next. Together, we'll navigate the financial markets and build a stronger, wealthier future. Thanks again, and see you in the next video.